Do you know what gets ignored when people write about trading or talk about trading? It's living through a trading drawdown. Now, traders understand that their account is going to ebb and flow like the price does on a chart. But when their trading account starts to look like a bear market due to an extended drawdown period, things change. Now, in simple terms, a drawdown is when your trading account starts to retrace after a period of losing trades. In more direct terms, it's a peak to trough decline measured over a certain period of time. And this means that your trading drawdown can happen during a single day of trading or over the course of weeks or months. And while we would all love an equity curve that continues to make all-time highs, it's not the case. This is an example of what a more realistic equity curve looks like. And when I talk about drawdowns, I'm referring to the ones that will plague you your entire trading career. And the flip side of that is the max drawdown you can expect from your trading system. Maximal drawdown is what you determine the greatest peak to trough differential is that can occur before making a new peak. And this is information that you should have calculated when you did your strategy backtesting. In doing a proper backtest of your trading strategy, you will learn the optimal risk per trade you should be using to sustain your trading account during the pullbacks in your equity curve. Now, just like a price chart does not simply go straight up, you are going to be spending a lot of time in trading account drawdown. And if you think that it's a rare event, just look back at that chart. About 70% is below peak. Do you think you could live through that? Now look around trade number 127. After that peak, your trading account was in drawdown for 30 trades before reaching a new high. And by that time, many traders would abandon their trading strategy, just look for something better. That equity curve chart highlights the importance of money management. If you do not control your risk and position size, taking into account drawdown reality, you will get wiped out when they come. Now, you still think you won't suffer drawdown that will affect your decision-making process? When I first saw these numbers, it hit home that risk is vital to not only limit the extent of a drawdown, but also to keeping my trading account in respectable shape. So you've taken losing trades in the past and you've no doubt have seen downticks in your trading account. Now, a short-lived drawdown is manageable as you keep working your trading plan. But then there are going to be those that test your resolve as you take loss after loss, and the equity curve peak is a distant memory. The question is, what can you do to live through this potentially painful reality of trading? Well, your ability to handle drawdowns is dependent completely upon how mentally prepared you are for them. This means that it's crucial you know your system's past max drawdown as well as you know your own birthday. And you should expect to visit a drawdown of equivalent size once a year, then an even bigger one sometime in the future. And if you're trading and you consider yourself a trader, you need to be very aware of what will happen to your account during that drawdown. If you do, you will be mentally prepared and have the intestinal fortitude to stick with the program through those tough times. And if you're not mentally prepared for the drawdown, you will make emotionally driven decisions at the worst possible time in the worst possible place. These emotional decisions lead to that trait that all bad traders share, and it's getting out at the lows. And how many of us have done that? And one of the main benefits of trading with an algorithm is to eliminate those counterproductive emotional decisions. Now, please don't offset that advantage by acting emotionally when you're in drawdown. Now, don't we all look at the drawdown stats from the evaluator and just say, yeah, I can live with that. Then we see those drawdowns in our account and we react like a deer in the headlights and we say, what's happening? I didn't expect this. It is completely unreasonable to expect a trading system to make money each and every day of each and every month. Things just don't go up or down forever. They peak and they valley. They go through up cycles and down cycles. And here's another equity curve example. This one here has a maximum drawdown of 21%. And if you started trading this system with $25,000 on January 30th, by July 25th, your account grew to $30,573. It was a pretty good steady growth with a few drawdowns that were thrown in. Anyone trading this would be sitting back on July 25th feeling really good because that portfolio grew 22% in just a few short months. So how prepared do you think you were for the next few months? A new equity high was not seen until November 18th. As well, on October 3rd, that account had fallen 10%. Do you think that you would have bailed around October 4th? There's a good chance that you would have. By January 13th, the account was back up to 33.6, and now you're kicking yourself. But wait, another drawdown is just about to start. However, this one was 9.7%, and then a new equity high was seen by March. So the max drawdown was 21, and the drawdowns experienced so far have been 10 and 9.7, which is completely in the realm of possibility. So you've looked at the equity curve of the system, and you know this kind of up and down is typical. So you measure each of your drawdowns, and you use the maximum drawdown to see if the one you're currently in is in the realm of possibility. But most importantly, do not be dejected by a drawdown, especially if it's well within the historical parameters that you've evaluated. And I believe that this simple exercise will get you used to what a drawdown is and will help you to live through them, since most of your time is going to be spent in them anyway. Now, the only way you'll never encounter a drawdown is just by not trading. So if you want to trade, you need to accept drawdowns. But more than that, you also need to expect a new maximum drawdown will take place someplace in the future. And if you approach your trading accepting the drawdowns, and you have an expectation of a new maximum drawdown somewhere in the future, you are never going to be a nervous wreck who cannot think straight when it does happen. You're going to take it in stride, you're going to step back, and you're going to assess the system rationally. Now, understanding that the larger the returns, the larger the risk. The larger the returns, the more volatility in your equity curve. You can easily get no risk by investing in U.S. savings bonds, but will you be happy with gains of about 2% per year? Probably not. And for that reason, traders are on the lookout for larger returns. But how many are prepared for the higher risk and volatility that accompanies that higher risk? Our natural tendency is to stop that which is causing us pain, which is our losses. And so a human's natural inclination is to quit a system when it's in a drawdown because it doesn't feel right. And you have to overcome this basic human instinct by making it all about the statistics and being prepared. Set a realistic line in the sand. A line that's based on your tolerance for losses and the stats of your trading system. And if you do this before you start trading and you make a pact with yourself to not flinch until that line is crossed, your daily mental battle of whether you should stick with the program or just dump it has been won. You'll have what very few traders have, and that's intestinal fortitude. A part of the problem with trading with any trading strategy is that it's too easy to quit. All you gotta do is stop trading. An investment in real estate or a hedge fund, for example, often takes more time to liquidate, giving traders time to let the emotion run its course and evaluate from a place of rationality. It is important to note the corollary to things don't go up forever. Things don't go down forever either. Trading systems are very cyclical. They make money and they lose money. Then they make money. It pays to stick with a system in its downturn because their cyclical nature means they will come out of it. Now, we've covered a lot of information. You know your drawdown numbers. You measure your drawdowns, you've accepted them, and you expect to have another one larger than the other one in the future. But there's one more very important question. What if the drawdown I am in is more than a drawdown and the system is not working in the market environment anymore? You need to have a mechanism to help you answer that question. You need to have a mechanism to know when it's time to move to cash, and you need to have a line in the sand. And one simple way to measure your drawdown is using a moving average on the equity curve. It tells you to stop once it's violated. And without this line, you could go crazy wondering whether the current drawdown equates to a broken system.